China's GDP grew by 6.4% in Q1 against the same period last year. The World Bank's lead economist for China says the Chinese economy remained resilient and the results came as a surprise.
The Chinese economy in Q1 surprised us on the upside. So growth was stronger than we expected at 6.4%. Resilient meaning that really since the external environment has been quite challenging since the fourth quarter of last year. That's why we expected actually the growth would be lower in the first quarter this year. And in January and February, it looked like it might be close to our projections. But then in March, we saw this big pickup.
The World Bank emphasized that China's economy will need to rely increasingly on domestic demand to sustain rapid growth amid the less favorable external conditions.
Well, there are quite a lot of industries in China that service the domestic economy, service domestic demand. China's market is quickly becoming the largest market in the world, the domestic market. And we do think that not only now, but over the medium term, that if China is going to sustain relatively rapid growth, it's going to have to be through domestic demand. It's going to have to lead the growth. There's not much room anymore for China to increase its share in exports in the world. And the world economy is not growing very fast anymore, not nearly as fast as the Chinese economy.
If China needs to rely more on domestic demand, then it will probably need more government support. And so far, the fiscal stimulus this year that was introduced in March actually emphasizes tax incentives. These tax incentives are targeted both at businesses to help them increase investment and at households to support household disposable incomes and raise household consumption. And one way the government can support that is by increasing spending on public services. That includes education, healthcare, and social protection.
The World Bank also said that with fiscal stimulus emphasizing tax incentives already introduced, China still has space to increase spending. It added that the additional stimulus could come directly from the central level or through additional fiscal transfers to the provinces.
If it becomes necessary to introduce even bigger stimulus, then the government could again introduce public capital spending, as it has done in the past. The central government in China has a lot of fiscal space to increase borrowing and increase spending. Local governments, many of them are actually constrained, so it's important for the central government to provide the financing together with a mandate to increase spending. Either they could provide larger fiscal transfers to local governments, or they could borrow on behalf, borrow centrally to increase spending.
Litwack also spoke highly of China's efforts to inject more liquidity into small and medium-sized firms in recent years.
SMEs generally have a hard time getting credit in most economies. The reason being that they don't have a lot of collateral. They can disappear, go bankrupt. So it's always a high risk for banks to lend to SMEs. We know that China has been promoting this, which we think is good. And in general, we have a very positive opinion about some of the trends that are going on in the banking sector. That a lot of commercial banks are now developing the skills, are reorienting themselves toward dynamic private firms, and that's very important for China.